through a deterministic system, i.e. a system that is not random but difficult to predict, we call it a chaotic system. And there are two kinds of chaotic systems. Level 1, where the chaos will not respond to the prediction. The weather, for example, belongs to level 1. It is difficult to predict. Any small changes in the initial conditions can lead to large differences in the future state of the atmosphere. Even today, with all the data at our hand, our ability to predict the weather accurately is only limited to the first few days. But at least our prediction won't change the weather. Level 2 is even more troublesome. Not only that it is chaotic, but the chaos will change the prediction. Say you come up with an algorithm to predict the oil price based on the demand, supply, and storage. If it tells you that the oil price will shoot up to $150 per barrel tomorrow, what will happen is that today, people will rush into the market, therefore pushing the oil price to $150 per barrel today. And what will happen tomorrow? Nobody knows. You see, our prediction of the oil price changed the oil price, making it even harder to predict. Hi everyone, I'm Mr. Te from The Modern Reminder. Welcome to Beyond the Ticker Tape, where we dive deeper than the market and price fluctuation with investment insights that last. Today we are going to talk about predicting the economy and financial market. Turn on any traditional financial news channel like Bloomberg, CNBC, you will see the report of economic data released and how the market would react to them. Being in the industry myself, I'm being bombarded by economic data released on a daily basis like GDP, PMI, IPI, unemployment rate, interest rate, M1, M2, M3 and whatnot. Have you ever wondered that how many economic indicators are there? According to tradingeconomics.com, on the website alone, there are more than 20 million economic indicators across 196 countries. Is this really what the investors want? Are they even practical? Should I spend more time tracking the economic indicators so that I can predict the market movement and therefore be a better investor? The answer is no, at least not for retail investor, and I'm going to tell you why. The answer is right there in the beginning, because the economy and financial market are chaotic and they belong to the level 2 type. In economic class, we learn the ABC. We get the clear-cut definition and impacts of each economic indicator. For example, GDP growth means economic expansion. It is a straightforward cause and effect relationship. But in real life, as we mentioned just now, there are more than 20 million economic indicators. And these pieces can work together in a surprising way. One positive indicator from one area might be offset by a negative one in the other. Or they could amplify each other's effect. Here's a real-life example. If you are a stranger to financial market, you would think that a stronger job growth will be bullish for the market, because strong job growth will create more spending, and more spending is good for the economy and therefore good for the market. But to financial traders, it is often means the opposite, because with stronger job growth, there will be more spending would cause inflation, and that will increase the likelihood of interest hikes by the Fed, and therefore is very bad for the market. But I remember there was a time that US payroll reported strong job growth, and according to the logic just now, the market is supposed to go down. But that day, there was a big rally. Why? Well, Wall Street pundits say that even though there was a strong job growth, the wages grew slower than expected. That is the explanation they gave you after the event. So next time, should I look at the job growth or the wage growth? And I'm only talking about how one job data potentially offset the other. Not to mention when the 20 million economic indicators come into the interaction. So what is the real reason the market went up or down? Nobody is supposed to know for sure. That's why we call it chaotic system. And worse, it is a level 2 chaotic system. Whatever the prediction is, it is always priced in and reflected in the market. We can understand this by looking at how we interpret the economic indicators. Traditionally, the lagging indicators were the primary focus. If we wanted to understand the housing trend, we would look at the existing home sales, which is a lagging indicator because by the time you look at the data, the sales were made already. And one day someone thought, hey, we could look at the housing starts data instead, because this data is available as soon as the construction begins. That way, we are one step ahead than the others. And later someone noticed that we could look at the building permits instead, because you need to get the building permits before the construction begins. That way you are even one step ahead than the others. Do you see what is happening here? We are constantly trying to be one step ahead than the others. In other examples, we used to focus more on the IPI, but also that is lagging indicator, because by the time you look at the data, production will already be made. And then we shift to PMI, which is based on surveying a group of purchasing manager about their expectation on the production and so on. From retail sales to consumer confidence index, from CPI to commodity prices, etc. What does this tell you? With increased access to real-time information, we keep taking it up a notch in order to be faster than the others, because we know that the previous one didn't quite work already. But it doesn't work that way. Someone might tell you that, oh, I don't look at these kind of indicators, they are the lagging one, they were already in the past, I look at the leading one. The truth is, no matter how leading is the indicator, if it is available to you, it is available to others, therefore it is already priced in. Efficient market. This explains why good data does not translate to good market movement and bad data does not translate to bad market movement. The data has to be better or worse than expected. In other words, if you are playing the prediction game, not only that you need to be right, you need to be right when others are wrong. And how can you do that consistently in a chaotic environment? I'm not saying that these indicators are useless. I'm just saying that it is useless to use them to predict the market. Some counter-arguments are saying that some economic data are more prominent than the others, like the interest rate, and the impact of this data is hard to be offset. And also the market expectation is not always right. If the actual data release differ from what the market generally expects, there will be opportunity to make money. For example, let's say the market generally expects the Fed to hold the rates, but out of the surprise, Fed decided to cut it, and a stock of your watch list went up by 10%, and that 10% is the reward you get by tracking the economic indicators. I beg to differ. It is easy to say that in hindsight, after the event, when the stock closed at 10% higher. In real life, you couldn't have known that. What if the stock went up by 6% upon the announcement? How could you have known that there's remaining 4% for you to reap? Or what if the price went up to 15% upon announcement? How could you have known that it will reverse back to the 10%? You couldn't. The key takeaway here is that as retail investor, don't be too obsessed with economic data. You can still read them to understand where we currently stand in the economic cycle, which is very important for portfolio allocation, but not as a tool to predict the market. Remember, the economy and financial market are chaotic, and they are the level 2 type where the chaos responds to the prediction. I hope this video also serves as a warning. If your fund manager or investment consultant are frequently making or suggesting investment decisions based on economic indicators, this is a big red flag. Spend your time in areas that exhibit less chaotic behavior. Like you can focus on specific industry, study their major players, their market share, the turnover of their market share, competitive advantage, barrier to entry, the underlying technology behind it, the rules and regulation, the potential threat of being disrupted, etc. This kind of knowledge has a longer shelf life, therefore worth your time pursuing it. That's it for today. If you have any question, you can click the link to the Google form below and our team will get back to you. If you like the video, press like, share, subscribe. Until next time.